All right, let's dive right in. We're talking about the multi-trillion-dollar world of private equity and a really big debate that's heating up. Does this powerful, and let's be honest, pretty secretive industry need more rules? Let's break it down.
So let's just put the central question right out there from the start. Should private equity have more rules? And look, this is not a simple question. It's super complex, pretty heated, and you've got really smart people making strong arguments on both sides.
When you peel back all the layers, this whole thing really comes down to a classic trade-off. On one side, you have investor protection, shielding people from unnecessary risk and hidden fees. But on the other side, you want market efficiency. You want to let capital flow freely to create jobs and grow the economy. So the real question is, where do you draw the line?
So here's how we're going to tackle this. First, why is this even a big deal right now? Then we'll get into the arguments for more rules and, of course, the arguments against them. And finally, we'll peek into the future and see what that might look like.
Okay, so first things first, why is everyone talking about private equity regulation now? What's changed?
Well, the simplest answer, it's just gotten huge. I mean, this industry has ballooned. It's so big now and so tangled up with the rest of the financial system that regulators basically have to pay attention. Its sheer size makes it impossible to just ignore anymore.
And yeah, that massive scale is the #1 reason people are saying, hey, we need more rules here. So let's dig into that. What are the main arguments for bringing in more government oversight?
Folks who want more regulation, they tend to focus on 3 big things: protecting the investors, managing the risk to the entire financial system, and the serious lack of transparency. Let's break each of those down.
All right, first up, investor protection. And you might be thinking, wait, the investors here are huge institutions, right? They can take care of themselves. But the argument on this side is that the whole system is so murky, so complex, that even these sophisticated players can get burned by things like hidden fees or sneaky conflicts of interest.
Okay, number 2 is systemic risk, and this is a big one. We are talking about trillions of dollars in capital here, and a lot of that is supercharged with a ton of debt, or what they call leverage. The real fear is, what happens if a bunch of these companies, all backed by private equity, start to fail? Could that trigger a domino effect across the whole economy? The worry is that nobody's really watching that risk closely enough.
And that risk we just talked about, it's made even worse by point number 3, the transparency problem. Basically, since there are no standard rules for how these funds report their numbers, it's almost impossible for anyone, investors, regulators, you name it, to really compare them. You can't just look at 2 funds and know for sure who's doing better or who's taking on way more risk.
Okay, so that's a pretty strong case for more rules, right? But hold on. The industry has its own powerful arguments for why things are fine just the way they are. So let's flip the coin and look at the case against adding more regulation.
And their case? Well, it also stands on 3 main pillars. Their investors are savvy enough to know the deal, fewer rules keep the market running smoothly, and there's already enough oversight in place, thank you very much.
All right. The cornerstone of the industry's argument is this idea of sophisticated investors. Their whole point is that the institutions putting money into these funds, we're talking giant pension funds, university endowments, they're not your average person buying a stock. They have entire teams of experts to do the research and to understand exactly what they're getting into.
The second big argument is all about market efficiency. The industry's big warning here is that if you start piling on a bunch of new rules, you're just going to slow everything down. It'll make deals more expensive, more complicated, and at the end of the day, it'll hurt the returns they can generate. And they argue that's bad for everyone.
And for their third point, they really push back against this idea that they're living in some kind of Wild West with no rules at all. They'll be quick to tell you that, hey, their fund managers are already registered with the SEC, they get examined, and most importantly, they have to follow the same anti-fraud rules as anybody else.
So you've got these really solid arguments on both sides of the fence. What does a potential middle ground even look like? Let's think about what a more regulated future could be. We're probably not talking about a total revolution, but more like a series of focused, targeted adjustments. So, if and when new rules do come down the pike, you can bet they're probably going to focus on these 3 key areas: more transparency through standardized reporting, keeping an eye on the use of debt, and beefing up investor protections.
First, and this is probably the biggest one, is transparency. What this means is new rules could force funds to report everything: their performance, all their fees, even how they decide what their assets are worth, all in the same standardized way. That way, you could finally compare apples to apples across the entire industry.
And look, this isn't just some hypothetical idea. The SEC is already on it.
They've actually proposed new rules that would do exactly this. A huge piece of their proposal is requiring funds to send out quarterly statements to their investors, and they'd have to clearly show how the fund is doing and spell out every single fee that's been charged.
All right, the second big area for new rules would be keeping an eye on leverage, debt. Now, the goal here isn't to get rid of debt altogether. That's a core part of how private equity works. The idea is more about preventing the excessive use of it, to limit deals that are so loaded with debt they could become a danger to the whole financial system.
And last but not least, we have enhanced investor protection. So this could mean much clearer rules about conflicts of interest for the investors in the funds. And think about this. If private equity ever opens its doors to everyday retail investors, you can be absolutely sure regulators would step in with some super strict rules to make sure they're protected.
And all of this brings us to the big final question. As this private equity universe continues to expand and become more and more powerful, is the way it's currently set up, that balance between driving growth and managing risk, is that actually sustainable for the long haul? That right there is the multi-trillion-dollar question that this whole debate is trying to answer.